Expected August pullback is resuming. We have the big growth stocks. I mean, Apple, Microsoft, Nvidia, all 10, 11% below their highs, yet the broader tape is holding together okay. Do you take heart in that? Do you feel like it's noise? Do you feel like it's delusion?
Maybe a little bit of all of those. I feel like there has been this sense of somewhat of this capitulation that's happening in the middle of the day in the last couple of days. And I think there really continues to be a very strong underlying bullish sentiment in the market. And I think it stems from the expectation that we're going to see soft landing or no landing. We've seen a lot of defectors from even the soft landing camp over the last couple of weeks. I think the other thing is that investors are trying to determine how much this CPI print tomorrow will change the narrative. And the thing is that a lot of the increases in energy prices, for instance, that we've experienced over the last couple of weeks probably aren't going to show up in this print. So I would say that this print tomorrow is likely to continue to be supportive of the fact that we're going to get a soft landing or perhaps no landing, rather than taking into account some of the challenges that we've experienced over the last week.
Yeah, it would seem that the numbers themselves, certainly if the focus is on the core, we think there's a little more to go there in terms of the year-over-year impact based on what was happening a year ago. On the other hand, with energy prices on the rise, energy stocks seeming to take some strength out of that. In other words, it's not just a fleeting blip. And what that impact might have, what the impact might be on longer-term inflation expectations, which are ticking higher, and the fact that bond yields are near the upper end of their range, it just complicates the narrative that we have Goldilocks, it's a comfortable environment indefinitely, and the market can make headway from here.
That last mile of inflation, we've been talking about this for some time, and the last mile was expected to be pretty much wage-driven, and so impacting the services sector. If you start to anticipate not just disinflation, but deflation in those underlying food and energy costs, which I think is what is being priced in from a consumer confidence perspective. If we go to the other side of that and say, wow, we could actually see some acceleration or reacceleration in the prices for food and energy, that's not just a core problem, that's a headline problem now. And so I think that investors really aren't anticipating that data is going to start to flow through. How is the Fed going to react to that? And again, when you talk about what happens over the next 6 to 9 months, I think what isn't being talked about enough in the marketplace right now is the fact that not only could we see a delay or a cancellation of a recession, but that means we also see rate cuts happening much later than was anticipated in the middle of this year. That has a lot of implications, particularly for those growth stocks that you talked about.
So it certainly has implications for, the cadence of rates and how far yields might be able to come down or whatever. On the other hand, we had rate cuts priced in at one point in the bond market in the latter part of this year, like starting next month even. Mm-hmm. That's gone, and the stock market's been okay with it. I just wonder if we've observed the relationship between the stock market and today's level of inflation. Even though the Fed's target's 2%, it's not like the stock market says we got to wait until 2% before we get bullish again.
Well, there's also a perception that 2% isn't necessarily the hurdle that they're
sure.
trying to meet, right? If you're anticipating that they're going to get comfortable around 2.5%, and again, it's not just about that terminal level or that target level of inflation. It's about the spread between where rates sit and where inflation is, and what is that spread should be over time? 150 basis points, 200 basis points, certainly not as wide as it's going to be now. And so I think the idea that we're going into this seasonally weak period, that we're coming off of an earnings season that has been better than expected, and I would say has provided, again, this nice lift and foundation for the rally, we're going into a much more difficult time. And so I think every piece of data is going to be influential. But I do think, again, there's this underlying sentiment that people want to be bullish here because the economic story is better than expected.
That is true. And that's been the dynamic. We've been feeding off of that in the markets for a few months.